Hello, everyone. Welcome back to another multiple choice question review through examprep.ai. Here, I am going to go through the all important topic of revenue recognition with you. And since we are on the FAR exam, that is going to be accrual basis. That is going to be revenue is recognized when we shall see. So, which expression best describes accrual basis revenue recognition? And I'm going to repeat this over and over throughout the entire exam that you will be working through with me on these videos. So a firm should recognize revenue when pledged. This term is a non-for-profit term and also is not entirely accurate. Revenue is recognized immediately per transaction. Nope. In no case is that true. Revenue is recognized when received. That is true if we were taking reg with our cash basis accounting. However, not the case here. Last, but certainly not least, because it's the answer, revenue is recognized when earned. That is the phrase of the day, the phrase of the year. Repeat it in your mind, and all the rules have to be based on this for recognizing revenue. Where we get a little confusing is the construction-based questions, which, is practice with those. So awesome, good stuff there. Let's move on to the next one. Okay, how should unearned rent that has already been paid by tenants for the next 8 months of occupancy be reported in a landlord's financial statements? Let's think about that for a second. You are the landlord, and you have rent that has not been earned, in which case it means it has not been recognized. Okay, what are you going to do with that? How are you going to treat it? Well, it says 8 months, so we can immediately cross off the long terms, because long terms mean something is over a year. In this case, it's less than a year. Now, is it a current asset or a liability? You've probably seen the unearned service revenue account before, or unearned sales revenue. That is going to be when you are prepaid and you have to perform your service. In this case, your service is to give the tenants 8 more months of occupancy and let them live there. In Netflix's case, that's give the users another month of subscription service of videos and movies. And in this case, that's going to be a current liability because you owe this to the tenants, you owe it to the users of your business. Final answer is letter B, current liability. It's a short term and you owe it to them. Recorded as a current liability, and each month of occupancy you provide for them, you will recognize another month of revenue, thus reducing that liability. Nice little bunch of questions here. Very important ones, I gotta say. I mean, not too in-depth, not too mathematical based. However, pretty important for your fundamental understanding, and I'm glad you're able to join me today. Keep powering through these questions. Grab a cup of coffee, get some water, go on a little jog, do what you gotta do to shake it up and motivate yourself. I believe in you, you should believe in you, and find someone else who believes in you. Make it a trifecta. All right, that's enough of that. Keep going strong, and I'll see you all next time.